we would like to move on, making the numbers count. Why financial analysis remains central to the credit risk management. And I'm happy to have on stage again Marion Burden. Marion will introduce herself a little bit and give some insights on that very important topic, financial statement analysis, perspective and challenges.
Thank you very much, Robert. My name is Marianne Burden. I work for SCHUMANN as a business expert. Before I joined SCHUMANN, I was involved as a credit underwriter in credit and political risk. So yeah, I do like talking about credit risk, financial statements, and in this session, I'm going to shine some more light on some of the latest trends I've seen. I think this year in the credit community, there's been a lot of talk about, can we look at something else? Not just financials, but non-financial factors or soft factors. Can we get data that's more real time? Can we use other data? And it's a very interesting and important topic. However, I feel a little bit that the traditional financial analysis has lost its shine in all this. So I'm going to put some perspective in the next 15 minutes on what I think drives these trends and where I think that the future is heading and the role that technology has as well in all this. So first of all, when I talk about traditional financial analysis, what do I mean? Well, I mean the analysis, obviously, of a company's profit and loss statement, balance sheet, cash flow statement, numbers and ratios, where you can quickly and easily assess the health of a company, the financial health, creditworthiness. Is this a counterparty you want to give credit to or not? To use a bit of a medical analogy, it's taking the vital signs of this company to assess the patient. Most of you will know, but to quickly run through the three items, profit and loss statement shows you the performance of your counterparty, starting with the sales or its turnover. It's very important to assess how big is the business you are dealing with, first of all. And then you see the cost at different levels, obviously, to see where the value is added. How the margins are, putting these numbers in perspective. And obviously you can see, is the business profitable, loss-making, maybe at which level does it make profits or losses, etc. So really that performance overview. Balance sheet, as we know, it shows what the company owns, what it owes, fixed assets, current assets, intangible assets, and how it finances the business. Broadly, the mix of equity, debt, some other liabilities. We can take some very important ratios that most of us have learned even in school to look at, from solvency to gearing, current ratios, etc., to really get a good idea of what that balance sheet looks like. You can link the two up as well, obviously, your balance sheet P&L. You can check how much return does a company make on its equity, how does the debt compare to profit levels, so how many years would it take to repay its debt. So overall, I always like to think about it in terms of financial flexibility. So if this company were to face a crisis, could it easily make it through, find some more buffers, maybe raise some more debt or more capital? The cash flow was mentioned in another presentation this morning, is very key, of course, in credit risk and in the current volatile times we're in. Cash is king. A company makes a profit, but does it turn it into cash, or how does it use the profits? Is any liquidity tied up in inventories? Is company investing in the future? Is it raising debt, paying off debt, etc.? So it's a very important element to look at as well. Even just a quick check of these three elements for a credit analyst, a credit manager, can give a lot of insight and can, lead you to the decision: do I need to do more work on this company? Can I give it a credit limit? Do I need to be careful? So we're all quite accustomed to do this, and it has a long history as well. So why are we now more concerned about accounts or wanting to find different factors? Why is that higher on the radar than it was before? There's always a time lag when you look at accounts. They're generally only filed once a year. You take the snapshot, company closes the accounts, works to put together the figures, internal audits, external audits, etc. And then obviously you publish these figures, you put the report together, you file it to the authorities. As a credit manager, you might get those numbers then, but usually they first go through the authorities, through your company's house, Bundesanzeiger or equivalent, when other information providers come in to process these numbers, to map them, to get them into agency reports, which then end up with you as the credit manager or credit analyst to look at. This time lag can be quite long, because generally, even for smaller companies, we give them a bit longer to do this. And it can be even up to a year before we see some numbers of a company. And that time lag has become more problematic for companies. We have always dealt with it or found ways around it, but now it's more important because we don't have very stable underlying indicators economically. And this has come up in previous presentations as well. We're not really seeing, for years we've seen, formulated differently, we've seen stable growth, stable performance of economies. We've seen low inflation, low and stable inflation, interest rates which were low, supply chains which were steady, borders were open, so everything was quite smooth. So we didn't see any big differences year on year causing any issues. I don't need to tell you that recent years we've seen a lot of disruptive events. We all know about it. The pandemic shut down many economies for several months in 2020, and they caused a big shift in supply. You know, we couldn't go out. We spent a lot of money on goods, putting pressure on those companies to deal with that massive upswing in demand. We saw governments putting in place big packages for furlough schemes to pay workers, other debt and loans that could be used. And following all that, we all know we had a big upswing again and a move to services and a big rise in cost. All this was made worse by the start of the war in the Ukraine this year, which drove up energy prices, you know, big input costs for many companies to very, very high, again, historically high levels. All this wreaks havoc with accounts. I think we all know it. It makes it very difficult to do business, to budget, to forecast. Your ratios will be skewed. It just makes it more difficult, really to make an assessment of accounts. And we're in September 2022 now. So for some companies, we're only getting the 2021 figures now, or maybe in the coming weeks. So it's the question you hear a lot as well, how much value can I attach to those? 2021 was a different year of low inflation, good growth, no war, very smooth going. I think that's the big driver now for those discussions in credit communities about other data. Is there something else? And obviously, as credit managers, credit analysts, underwriters, we have our own pressure as well. Pressure to find staff to do reviews, margins, do it efficiently. Can we still grow? Still manage that book in a more difficult time. We need to keep in mind that non-financial factors, it's nothing new. And especially payment experience or trading experience, we've used very widely. You know, we've generally said, well, the accounts, they're done, we're a couple of months ahead or a year ahead. Company pays its bills, so it's a very important liquidity indicator, it's fine. So that's well established. But I think all of us have also used data from social media, online searches, maps, etc., to add up to the story of underwriting. The problem is we have so much more data and we're using different sources. I think we're a bit now thinking, you know, are we leveraging this enough? Can we do more with these data sets and get better predictions, better modeling as well? In all this, financial analysis, I think, has lost its shine a bit, but it remains crucial. And the reason for that is, there's multiple reasons. First of all, you generally have a portfolio of risks, which will contain larger risks, risks that hit you more, large amounts, long tenors, very important clients. I think for those clients, you need to take the vital signs. You need to always keep doing it, keep spending time on the numbers, the story. These are generally larger companies. You'll get notes to the accounts, which contain very important soft factors already. Where are the sales based? Where's the growth coming from? How are the costs split? What liabilities are there? What are the details of your debt? So you can do a lot with this. And for larger companies, you get information relatively quickly, details, and with interims. Although I have to note, interims are much more available for smaller companies these days as well. Then most people with good credit management software, you can do a lot of detailed analysis on those risks that really could hurt if they were to encounter any issues. You can look at long-term trends. You can look at key performance indicators, again, really measuring those vital signs. You can look at peer groups, industry groups, geographically, to compare how a company is doing in relation to its peers, its competitors, to really see who's doing well. And you can do forecasting. You can look ahead. You can make scenarios with increased input cost, energy prices, inflation, to see how companies should be doing. And that's really there. And I think we need to keep spending time on that and see if there's anything lurking under the surface. But in your portfolio, you'll also have smaller companies, smaller risks, SME. And this is a key point for analysis as well, not just on the risk side, but also for opportunities. As we're moving into a climate of higher insolvencies, which we're all expecting, you could see smaller losses add up. That still hurts. But also you could find new opportunities if you better analyze small companies. You know, if you can offer credit to smaller businesses that maybe a couple of years ago you couldn't do based on the accounts. I think technology will really make the improvement here. And financials will remain key. My prediction is that filing times will come down also for small companies. We're not in a time anymore that small companies have shoeboxes of receipts that need adding up, inventory that needs manual counting. Not at all. There's a lot of clever accounting software aimed at small companies that helps them with that finance function, pull together data more real time. And the challenger banks as well are very important. They're offering much better banking products for small businesses to manage their money, put their expenses on, again, moving away from big paper trail. Digital payments, equally important. Clients nowadays, accelerated by the pandemic, pay digitally with their contactless card or with their phone. And this is also a very important driver for making accounting a lot easier. The sales recorded straight away. Again, no receipts, no money to be counted. Tax filings, the OECD reported that in the pandemic, digital filings increased by 30%, and worldwide, the majority of taxes are now filed online, which is a win-win situation. Obviously, it's much easier, less time-consuming, less prone to mistakes. And it's one of the steps that improves that highway of steps that I've mentioned before, from doing your accounts to you as a credit manager having the accounts. It will be much quicker, less manual to get good information and comparable data as we all improve this. So the future, it's really about real-time data. You'll get insight into the kitchen of your counterparty on a much more regular basis, and even maybe real time. This already exists. The EU, through its open banking regulation, has allowed that companies, by mutual agreement, can see to each other's bank statements, so you can see straight away cash balances, what money is being spent on. So you get that real-time view of a company that we are looking for. The risk here is that as we get more data, and we're flooded by everyone's bank accounts and receipts and spending, that we go back to spending a lot of time on these companies. But what will happen is that with the data, we can use machine learning, artificial intelligence, to see better patterns, to do more prediction, to really use these big data sets to get a much better view of credit risk and patterns to support the credit manager. Summing it all up, some of this sounds scary, yes, this real-time data, sharing that sort of information with a counterparty. But I think, as with other technological developments, maybe 10 years ago or longer, we didn't expect we'd be banking on our phone or doing conferences online. I think it is part of progress. It will offer opportunities. You can grow and manage your portfolio better. You can spend time on those big risks where the technology will help you filtering out the smaller risks that need attention without you going through the data and interpreting them by hand. Technology will sit alongside you. I don't think the credit manager or credit analyst role will disappear. It will just get better and better supported. And those data will really help us with assessing credit risk, which is still not an exact science to do it. In all this, though, as we look at more data, the numbers will remain key. We will keep looking at financial factors, financial ratios, accounts, liquidity. It will remain key in helping us assess credit and credit risk.
Yeah, Marianne. Oh, wow. What a topic. And you explained that into detail, what are the challenges and the capabilities are. And looking into our chat, there's a question coming in regarding the topic. So in times of uncertainty, volatile environment, how do you see the prediction capabilities of financial statements in terms of liquidity, the capability of a company to pay the bills? What are the challenges at the moment, and the utilization of financial data to give an answer on that?
I think it's getting better because we are pulling together bigger data sets and we have more capabilities to look at large numbers of data. Often with insolvency, and when we've tried to do predictions, always been, well, there have been so few insolvencies, can we make the data very relevant? But now we really can pull together the very, very large numbers. I think the challenge is going to be is that this year we're facing some events that we haven't seen in a long time. So our data set would have to go really back very far to see a time where we've had inflation in double digits. So it's maybe a bit of a challenge, but I think in steps we are moving forward to using a lot more information that we have. And I think we'll always keep combining things like trading experience, it will stay there. But our prediction capabilities over time will go up and will support the credit manager much better in work and in managing the portfolio.
Yeah. So what you're saying is that the combination of different information types completes the picture, taking financial statements into account as well as payment experience and maybe traditional credit rating agency reports and information coming from the trade credit insurers. What's your feeling about the discussion taking other soft facts into account in that respect? What do you see here?
It's a very interesting discussion, and I know a lot of companies have looked at this, and what often comes up is internet searches, social media. Can I pick up something in behavior or postings? I think this is one. We would like to use it for small companies, but there's not enough information. So I think it's a difficult one. So I think in the basis we'll be going at, when we look at someone's behavior, we'll go into the bank account more than the LinkedIn profile. That's the trend. And other soft factors, they're going to be skewed a bit towards big companies. Obviously, big companies have so much information. There might be a bit more online to take out a trend, but the focus of a lot of companies, banks, financial institutions is, can we reach that market of SMEs and smaller businesses? And I really think we're going to go back to account and much quicker filings and details there.
Yeah, I think, in credit risk management, the data collection leads to the point that a certain database should be a single point of truth. So talking about the truth, it's a big word. So taking data from the internet, it could happen that it's also be a little bit vague. But how valid data are? Yeah,
and that's what we've seen. And especially if you have very small numbers of postings, obviously, what do you do with that? So we need to be very cautious there. And again, it will maybe work for large companies where we have a very large number, so it can filter out these things. But we'll get more data. You know, a couple of years ago when we would get payment experience, sometimes it was, you know, it had to be filed to the information provider. So you looked at it and it was, well, this is based on 3 payments. But nowadays we can gather those data much easier from lots of companies, from our own company in large numbers. And you know, that makes the data much more reliable if we can get them in large volume. Technology really supports us there, and we'll keep moving forward.
Yeah, in terms of technology, what we also found is that there's so many Excel applications are around, but not fully integrated in the IT environment and not fully integrated in decision-making process. What do you see? What are the advantages to use a proper technology to embed that?
Well, just having everything in one place on one screen, that drives efficiency, of course, not having lots of screens open and dealing with shared spreadsheets. You know, I think it's important to keep your information in one place, manage it, manage your book, your exposures. You know, when something happens in the world, you want to quickly be able to see where's your risk and take action. So yeah, in technology, we're really seeing people want to have the platform, everything in one place, a stable environment where there's good control and security for people to work in. It helps the business across the board, obviously. And I think everyone's glad to get rid of big spreadsheets.
So that rounds up the idea looking into financial statements, analytics. So, Marianne, thank you very much for all the insights today. Thank you.
Thank you.